perfect recipe for retiring. This is series 23rd. My name is Bhuvan Gupta. I run this company called Client First Capital. A brief introduction about us. We are a Mauritius regulated entity. We are now as a group roughly 7.5 years old. We are as bootstrapped as an advisor. We wanted to serve the client, and from day one, we were very clear that we are here for our clients. And eventually, after becoming an advisor or distributor to a lot of other big investment houses, we started our own fund called Founders Portfolio. We've got inspired a lot from Ramdev Agrawal, from the Rakesh Jinwala, Warren Buffett, and Peter Lynch. All money we made to the client in 19, 20, and 21 is inspired from Warren Buffett and Peter Lynch's investing principle. This year is yet to complete, but as we all know that index is 24% down, we are similar in the same range. These sessions are helping us to learn because these are the difficult time to learn. No point looking at the portfolio and just saying that, oh, it is down. But the idea is to recheck your portfolio with the thesis and the theory you have read and you have applied in the past, and which has helped you to make money. So we are a long-term investor. We have presence in 3 countries, Mauritius, India, and Dubai. We would like to become a global startup soon. I think there are plans to start Client First Capital Africa and Client First Capital Canada. And once it is materialized, I will let you know. We would like to reduce the wealth inequality in the society. A very difficult job, because we strongly feel that when we tell this concept of power of compounding, the high net worth individuals really get impacted and impressed. But when we explain this to the person who basically have a, let's say, a handful of a salary, for him, it is actually not a very exciting principle, because somewhere down the line, he want to make money quickly, and he get into the perils of Bitcoin and cryptocurrency and the CFDs and the leverage, etc. So this is a very difficult task which our company is doing to create HNI. But having said that, there are people who are understanding our vision, and we are onboarding them at least one client every week. So the idea here is that we would like to create HNI. We want people to retire with $5-10 million after 20 years, and they keep on investing as a SIP or as a lump sum. But the idea to make at least double-digit money, which will become very, very significant in the time to come. Now, the customer comes first. The employees are also treated as a customer. We want our employee to grow. The human development is the most important aspect. Sooner and later, we will start giving ESOPs to the employees and the investors, so that they all become the part of the success story. Now, let's come to the topic. The topic today is basically, and why this topic? The topic today is the Graham, who is the one of the founder and father of value investing. Ben Graham has written a book which is now complete. So I think the book is not visible to you because of my background. Let me remove the background to show you the book, because the books are very important. Give me 1 second. Okay, so I think now the book is visible. So if you look at this book, Security Analysis, this is the book written by Ben Graham and Dave Dood. Who was a professor in Columbia University. Columbia University has quite a good billionaire investors in the world, and some of them belong to this school of philosophy. And the other book is The Intelligent Investor. Any child or any person who would like to start investing in the stock and bond market or any market can get a deep insight from these books. I'm very disappointed that in my MBA, these books have not been taught. In my banking career, these books have not been recommended. But it is a destiny that I got into these books, and thank you for you. Because of you, I am reading these books again and again, and my thought process and my confidence in the value investing is growing big and big. So now coming to the students of Ben Graham and David Dood, basically David Dodd, he's called David Dodd. So now Waters calls of WJS partnership who had no formal education, which we will come to know in the later part of the webinar. From 1956 to 1984, returned a 21.3% annual compound return with hundreds of stocks, with a very simple investing philosophy, vis-a-vis the 8.4% for the index. It is a remarkable record, and I'm very happy to tell you that he's no more, but his writings are available, and he can be well read. And he's such a, if you listen to him, if you watch him, it's so boring. But that those days he was very clear about two things. He says we don't like bond much, and he never took leverage. That kind of simple investing principle he had those days. And again, repeating, he had no formal education. Then Tom Knapp and Ed Anderson of Tweedy Brownie, who had delivered 20% for a staggering period of roughly more than 13 years odd, and vis-a-vis 7% of the market. The third person is Bill Rowan of Sequoia Fund, who Warren Buffett, when he dissolved Berkshire Hathaway partnership, wanted him to take over this particular all the money of the partners. He wanted Sequoia Fund to take over. Sequoia Fund from 1970 to 1984 delivered 18% per annum versus 10% from the market. That's a huge record for roughly 14 years. Then comes Warren Buffett partnership, which I always talk about, and I am very much influenced by this partnership, and that's how I started the Founders Portfolio. And even the fee structure is very much aligned to what Warren Buffett used to charge. 1957 to 1969, Warren Buffett delivered 29.5% per annum return versus 7.4% from the Dow. So a question comes here is that what is the return of a company called Berkshire Hathaway versus Buffett partnership? Obviously, Buffett partnership delivered more return as compared to Berkshire Hathaway. And the simple answer is the size. The company has become bigger, and once you become bigger, there is something, a very good saying, that the size is the enemy of growth. And but still Warren Buffett maintained roughly 15% to 18% CAGR return for the last 40, 45 years or 50 years plus the company is. Then comes Charlie Munger. Charlie Munger was a lawyer. We all know he's 99 now. He's the vice president of vice chairman of Berkshire Hathaway. From 1962 to 1975, he also handled money being a lawyer, and he delivered 19% per annum vis-a-vis 5% for the Dow Jones index. So those days, people used to compare with Dow Jones Industrial Index, because manufacturing had a more weightage in American economy. As today, it is more of an S&P 500 and Nasdaq, where technology dominates the whole show. Now, coming to Rick Green of Pacific Partners, he delivered 32.9%, a staggering record. 32 is the highest among the lot, and I think this makes me curious to know more about the Pacific Partners, who delivered more for roughly 18 years odd. They delivered 32.9% per annum return with a 7.8 from the market. Then Stan Palameter of Palameter Partners, who delivered roughly the same period, he roughly delivered 23% per annum versus 7% from the Dow. The reason to read these people, the reason to go through these people's track record is to understand that how well they have been doing, and why they have been doing, and what is their investing philosophy. Have they leveraged ever? What exactly are they shorting the stock? Are they buying the derivatives, etc.? And I think that is why I would like to communicate this message to the whole investing world, that these people have not done these kind of activity, and they yet made money, and we will see the similarity between them. Now, from where am I getting this particular subject? So in this book, Intelligent Investor, when this security analysis book completed 50 years, this is the 1935-37 book. And in 1984, when Warren Buffett is giving a speech in the Columbia Business School, he is writing a title. So he basically gave a speech called Superinvestors of Graham-and-Doddsville. And that speech has been written in this book in the end. And in that, Warren Buffett has given the track record of these investors, and he has vouched personally that all these track records have been audited. He also said that I have personally met these people, I have personally known these people, and I know people who have made money through them. So he was giving an example that today in this beautiful world, we know a lot of these people who claim they know the market, they foresee the market, they predict the market. So what Warren Buffett wrote in this article, that let's say today morning I flip a coin, I wager a coin or dollar, and then there are a lot of people who get tail and there are a lot of people who get head. Now, if there are, let's say, 225 million people and they all toss a coin, there will be half of them as winner and half of them might not be as winner. And if you continue to go like this, you will find that there are people who would have, there will be exactly 225 people who would have made roughly $1 million, because every time, so let's say we toss a dollar, a coin, and if it comes head, I win. If it tail comes, you win. And like that, if we keep flipping between these 225 million people, we'll reach a point where there are 225 people who are rich by $1 million. And then they will be attracted to tell their story to the masses. They'll go and tell these stories, and people will attracted to this because it's a very, very short way of making money. Like, I think in somewhere I feel that Bitcoin is the same kind of a fundamental where people are doing the network marketing. And every time I sell it to you, I make 10%. Everybody is basically gaining 10% or 5% when they sell these kind of cryptocurrencies. So suddenly what happened, there are so many rich people who have been created. And then these rich people are being looked by our investors. And then now they want to become like that. So what he's saying, what Warren Buffett is saying, that I understand that you might think that when I'm talking about these these people, you also will think that it is something like that. He said, no. Why? Because Ben Graham and David wrote in his Columbia Business School classes have laid down the intellectual principle of value investing. But the way these people flip the coin, the way these people chose the stock, the number of stocks, all that has been different to each one of them. And hardly one or two stock would have what you call been common, but they all have developed a separate track of their own. And then what made him curious to understand that what exactly Ben Graham has taught, and that is what I'm presenting to you here. So Warren Buffett has taken a personal ownership while saying that this is not a flip of coin. This is not that when these people made money, a lot of people lost money because of them. Investing is a win-win situation. Speculation is a win-loss situation. And we will hear from him itself about these concepts. Now, what are these concepts? What Ben Graham actually taught? Ben Graham taught about value investing. Now, value investing, what value investing is? Is it different than growth investing? Are they two different things? People talk about we are investing, let's say, in a growth company like Amazon. Is Amazon not a value investing? We'll hear from Warren Buffett that how these things are not either separate or not separate. Then we'll talk about how to value a business, which very important concept, that how do we value a business? Let me give you an example. How do we value a bond or a property? So if I buy a bond for, let's say, next 5 years, if I am getting a 5% interest, I might be ready to pay $101 today to receive 5% coupon from these bonds and $100 after 5 years. The reason I'm okay with that, because, and let's say it is the same rated or the investment rated as the bank fixed deposit are, because bank fixed deposit today are giving between 3 to 4%. But if interest rate goes up, what happens is this bond has to offer me more return, and eventually now this bond will fall and I will have an opportunity cost. So that is the concept of value investing, that how much I should be willing to pay to this bond so that I get a 4 or 5% coupon and I am making more than the inflation or the fixed deposit. Now, what are the components here? One is the interest rate. The other is the discount rate. And this is a very simple investing, because the bond investing in terms of valuation or calculation of the valuation is very simple. Stocks are not that easy. Coming to property. Now, if I buy a property, I have two components. One is the growth or capital appreciation, and the second is the rental return or net rental return after adjusting for the maintenance cost. So let's say when I buy a property for, let's say, 1,000 dirham per square feet, and I'm getting, let's say, a rent of 3 or 4% in a year, that's absolutely fine if my property in the 3 to 5 years can become 1,500, 1,600. But if I'm not getting any capital appreciation, it needs to sufficiently reward me 6, 7, 8% rental return. So I will be compensated for any growth in the fixed deposit or the interest rate. So that's how I will understand what value investing, when I'll understand how much cash I'm giving today in order to get the cash in the future. I think in all our businesses, whatever business we do, we all understand that we are gaining either 10 or 15% on our return on investment in the business. So in 3 to 6 years, we eventually get back our capital. That's all about the value investing. But let's hear from the man. So 3 concepts, friends: value investing, the margin of safety, and then we talk about the interest rate or the discounting. And then we come back and look at the record of these investors. So first thing I'm going to do right now is to run the value investing. And is that separate from the growth investing?
Mo Spence from Waterloo, Nebraska. You've often stated that value and growth are opposite sides of the same coin. Would you care to elaborate on that? And do you prefer a growth company that is selling cheap, or a value company with moderate or better growth prospects?
Well, actually, I think you may be misquoting me, but I really said that growth and value, they're indistinguishable. They're part of the same equation, or really growth is part of the value equation. So our position is that there is no such thing as growth stocks or value stocks, the way Wall Street generally portrays them as being contrasting asset classes. Growth usually is a chance to, growth usually is a positive for value, but only when it means that by adding capital now, you add more cash availability later on at a rate that's considerably higher than the current rate of interest. So there is no, we calculate into any business we buy what we expect to have happen in terms of the cash that's going to come out of it, or the cash that's going to go into it. As I mentioned at Flight Safety, we're going to buy $200 million worth of simulators this year. Our depreciation will probably be in the area of $70 million or thereabouts. So we're putting $130 million above depreciation into that business. Now that can be good or bad. I mean, it's growth. There's no question about it. We'll have a lot more simulators at the end of the year, but whether that's good or bad depends on what we earn on that incremental $130 million over time. So if you tell me that you own a business that's going to grow to the sky, and isn't that wonderful? I don't know whether it's wonderful or not until I know what the economics are of that growth, how much you have to put in today and how much you will reap from putting that in today later on. And the classic case again is the airline business. The airline business has been a growth business ever since, well, the Orville took off. But the growth has been the worst thing that happened to it. It's been great for the American public, but growth has been a curse in the airline business because more and more capital has been put into the business at inadequate returns. Now, growth is wonderful at See's Candy because it requires relatively little incremental investment to sell more pounds of candy. So it's growth, and I've discussed this in some of the annual reports. Growth is a part of the equation, but anybody that tells you you ought to have your money in growth stocks or value stocks really does not understand investing. Other than that, they're terrific people. Charlie?
Well, I think it's fair to say that Berkshire, with a very limited headquarters staff, and that staff pretty old, we are especially partial to laying out large sums of money under circumstances where we won't have to be smart again. In other words, if we buy good businesses run by good people at reasonable prices, there's a good chance that you people will prosper us for many decades without more intelligence at headquarters. And you can say, in a sense, that's growth stock investing.
Yeah, if you'd asked Wall Street to classify Berkshire since 1965, year by year, is this a growth business or a value business, a growth stock or value stock? You know, who knows what they would have said. But, you know, the real point is that we're trying to put out capital now to get more capital, or money. We're trying to put out cash now to get more cash back later on. And if you do that, the business grows, obviously. And you can call that value or you can call it growth, but they're not two different categories. And I just cringe when I hear people talk about now it's time to move from growth stocks to value stocks or something like that, because it just doesn't make any sense.
So one very good thing which he demystified here is that you would have heard a lot in the newspaper or in the media that time to leave the growth stock for value or value for growth. They are nothing but basically same thing, because every value investing has to be coupled with growth investing. So how do we learn from this? It's a very simple thing. Whatever stock you are investing in, go and check if they had a good growth track record for the last 10 years. Are they growing their profits, their free cash flow, their revenue? If they are growing so, and can they grow in the future? So every value investing is, in nutshell, is growth investing. They're not two different things. So in a manner, one thing he said this. The second thing he said that we don't want to be smart again. For example, when I went to the US and I saw a lot of this subsidiary which is owned by Berkshire Hathaway, and I highly recommend all of you to come and visit Omaha next year, so that you also understand that investing is not a rocket science. Just don't get into any stocks because people are talking about it. For example, I know somebody who bought Zoom's video communication software share at $600, where I bought it at $96, and it is now $73. I still feel that I would have waited more. No, it's not easy, but when I bought it at, let's say, price to earning of 25, this man, I don't know why he bought it at $600, and I know him personally, and he has no regret, and he does not understand whether he has taken a right value investing decision. The idea here, what Charlie Munger said, that we don't want to become smarter. We don't need to sell a stock to make money. So ideally, when you buy a stock in 3 to 5 years, you should get the whole capital back, which means if I invest $100, my stock value should be minimum $100 more in the next 5 years. And then it keeps on growing. So even if I take my principal back, I have the $100 growing for me. And that's what essentially value investing is. And that's what Ben Graham has taught. And that is what Charlie, just now we saw that Charlie Munger and Warren Buffett has explained to us. So now going to the presentation further. So now we were at this man called Walter J. Squalls. His son and him had no formal education, as I just told you. He died in 2012, and he had got roughly 100 stocks in his portfolio, and he roughly made grew the wealth by 1,000 times in 45 years. He was a philanthropist. He has worked for Ben Graham, and his investment record is 15% annualized. And he founded a business called Walter Edwin Squalls Associate. Now look at his yearly track record. Now, yearly track record is of not much importance, but I would like to highlight something here. Now, if you look at first year, S&P 500 in 1956 delivered roughly, one second, I have a chat message. Okay, so in S&P 500 in 1956 delivered 7.5% return, where WJS partner delivered 5.1% return, where they have not beaten the index. And if you find, there will be 1 or 2 more years where they have not beaten the index. So the whole idea here, which I would like to communicate with using this parameter, that there might be a year or two where even the best of the best investor might not be able to beat the index. Now, why is so? They will not be able to beat the index because they might be buying the stocks which will grow in 3 to 5 years, where the market might be busy in giving prices to to darling stocks like the .com in 2000 or 2008 financial stocks. So that might happen. So there is no need to see if your money is being managed by somebody who is having a great track record. No need to be very peculiar to the 1 year or 2 year performance. But over a 5 year period, if he is not performing, then actually that fund manager or that investment method is not correct. Now look at his total track record. He may compounded the wealth roughly 231 times. In a 28 and quarter year, he compounded the wealth 231 times, where the Standard & Poor has only compounded 8.4%. And if you look at the limited partner return, he actually delivered 66 times return in the 28 and quarter years for these people. Now, what did he do? He basically owned more than 800 stocks during this time. And the present value when he actually left everything out was $45 million. So that's what Walter J. Scholes, who never went to the college, the formal education, has delivered. You can read about him. There are articles on him. There are plenty of things about him. He has got his YouTube video also, which you can hear. Now, the second person is Tweedy Brownie. All these people had worked with Warren Buffett at Ben Graham, fund. And Ben Graham were 3 partners, and the 4 people out of 4, I just talked about Walter, and the second person is Tweedy Brownie. And all these people have the track record have been found by Warren Buffett. So this person, this company ran basically a fund which is founded in 1920. The headquarters in Stamford City, and at December 2012, they managed $13 billion in separate accounts and 4 mutual funds. Now, what was their investing method? Their investing method was very simple: low price to book value, low price to earning ratio, significant stock repurchase by executive officers at a company, particularly when stock price drops, indicating insiders have confidence in long-term company prospect. Now, this is very important. And then significant drop in stock price and a small market capitalization. So these things are telling us today could be a great time to buy the stock. Nobody knows the bottom. Nobody should try to know the bottom, but that's one. Second, how do I justify this? I can actually go and check the third point. Are the promoters buying their own stocks? If promoters are buying their stocks, it means they're very confident that this price is below the intrinsic value of the stock. So we will talk about the intrinsic value in a small time. And he has focused on a small market cap. As I told you that the size is the enemy of growth. That's how Tweedy and Brownie has delivered a fantastic track record by focusing on a small market cap. Now let's look at what is their track record. They delivered roughly 16% odd in the 15 years and roughly 16 years, a 16% CAGR, which eventually given limited partner roughly 9 times return in this period. And that's what Tweedy and Brownie did with a simple philosophy of investing, which I just told you. Now let's move to the third person. Now, third person is my guru, my humble pranam to Warren Buffett for so many books are written on him. He has openly talked about the investing, though it looks very easy, friends, but definitely not easy, because something around 80 years odd he has been investing and reading him, and he also has changed over the period. The value investing has little bit changed in terms of the concept. So Warren Edward Buffett, who is now 92, and he has taught a lot of value investing classes, has a fantastic track record of Buffett partnership, which is the guiding principle for me to start Founders Portfolio. In 1957, he started. And in 1969, he dissolved Buffett partnership to form the Berkshire Hathaway. His track record is roughly 14 times he has delivered in these 13 years. So if you look at his track record, he's basically compounded 23.8% year on year, or CAGR, for the limited partner, vis-a-vis 7.4 from the Dow Jones Index. A fantastic track record for a man, and he is, I think, is like a cult. Now the next person is Rowan Cunniff and Golf Hub, which is Sequoia Fund. I just told you Sequoia Fund was the only fund recommended by Warren Buffett when he dissolved Buffett Partnership Limited. Now, Sequoia Fund is best known and it is still in the existing, and you can actually look at CSEQUX, though the partners are not no more. These people also went to the Ben Graham School of Value Investing. And if you look at their track record, they delivered roughly, so they have a different type of fee structure, and they delivered roughly 17.2% or 18.2% odd return for, and or if you look at the cumulative growth, it is roughly 8 times over a period of roughly 13 years, 13 and a half years. That's what the Sequoia Fund. Now comes Charlie Munger. Very few people know that Charlie Munger also used to run a Charlie Munger Partnership Limited. When I was reading the book Almanac of Charlie Munger, which is a very huge volume, I came to see his track record. And even as a lawyer, he used to invest money, which he later on gave it to Warren Buffett to manage. Now, Charlie Munger has also a very good track record. He's 99-year-old. He's known to be for his to-the-point answer. He's a very witty person. And his famous quote on Bitcoin is that it is stupidity. And now when the prices have corrected, he said that God has his own way of punishing the criminals. It is all his words. I may endorse, I may not endorse because I have no idea about the cryptocurrency. Now, his partnership has delivered roughly 19.8% overall and 13% for limited partners, where so there is no comparison given the index. So he also has beaten the index. So that's what Charlie Munger, again, a Ben Graham School of Philosophy. Rick Gruen is the last, I think the Pacific Partners Limited he founded. And this man is little known, but not many people know that he was also part of the Berkshire Hathaway, and he then later on left the company, and he is basically run a fund called Pacific Partner, and they together came back to buy a company called Blue Chip Stamps. Now his track record is also very, very fantastic, and that's what I told you that I want to read about this person. So if you look at some of years where the S&P gave 11%, he delivered 114%, and that is remarkable. And then again, S&P gave 23% return. He actually delivered 127% return. Obviously, but he was also in 2 years having 42% and 34% and negative. So maybe this kind of a person somebody would like to emulate or learn from. So this is very curious, making me very curious to understand how he delivered 55 times return in the same period when S&P 500 delivered only 3 times return. Or at the partnership level, he delivered 222 times return. So I'm going to make sure I'm going to read about this person if I get his book and how he did it and what changes I can bring into my investment philosophy to beat the track record. So he actually, or match the track record, he managed to give 23% return. And at the fund level, he managed to make 32% return. So what the point there are other people also, the point I'm trying to draw here, that Warren Buffett himself, who is now advocating that once he will not be there, he wants people to invest into the passive funds, where he himself has written in 1985 that markets are not efficient. And there are people who have
Come on, guys, wear your shoes.
There are people who can actually beat the market, and they have beaten for a long period the market. And these people come from a village called Graham-and-Doddsville College, or the Graham-and-Doddsville Institute. So I think I recommend all of you to read this book, or at least to your children, or you can send them to us. We will be happy to take them through the book so that they will not speculate and lose money and by overpaying for the stocks. Now this man, he has given roughly 23 times return, and by compounding 23% for a period of roughly from the 1965 to 83, and where the Dow Jones only deliver 8 times return. So that's again a person coming from the Ben Graham school, investing school. Now, the most important thing is what was similar among these people. Now let's focus on the similarity. Now, all of them, as I told you, were early students of Ben Graham's school of thought. They all search for discrepancy between the value of business and the price of those business in the market. Now, value of the business is called intrinsic value. Now, what is intrinsic value? Let's understand how to calculate intrinsic value and from the Warren Buffett himself.
One is, how do you find intrinsic value in a company?
Well, intrinsic value is what is the number that if you were all knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. Now, when you look at a stock, when you look at a bond, so it's the United States government, it's very easy to tell how much you're going to get back. It says it right on the bond. It says when you get the interest payments, it says when you get the principal. So it's very easy to figure out the value of a bond. It can change tomorrow if interest rates change, but the cash flows are printed on the bond. The cash flows aren't printed on a stock certificate. That's the job of the analyst, is to print out, change that stock certificate, which represents an interest in the business, and change that into a bond and say, this is what I think it's going to pay out in the future. When we buy, some new machine for Shaw to make carpet, that's what we're thinking about, obviously. And you all learn that in business school, but it's the same thing for a big business. If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you instead. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference after as you get further out. And that is a question of how much cash they're going to give you. It isn't a question of, it isn't a question about how many analysts are going to recommend it or what the volume in the stock is or what the chart looks like or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset, oil in the ground, you're laying out cash now to get more cash back later on. And the question is how much are you going to get? When are you going to get it? And how sure are you? And when I calculate intrinsic value of a business, when we buy businesses, and whether we're buying all of a business or a little piece of a business, I always think we're buying the whole business because that's my approach to it. I look at it and say, what will come out of this business and when? And what you really like, of course, is them to be able to use the money they earn and earn higher returns on it as you go along. I mean, Berkshire has never distributed anything to its shareholders, but its ability to distribute goes up as the value of the businesses we own increases. We can compound it internally, but the real question is, Berkshire selling for, we'll say, 105 or so billion now. What can we distribute from that 100? If you're going to buy the whole company for 105 billion now, can we distribute enough cash to you soon enough to make it sensible at present interest rates to lay out that cash now? And that's what it gets down to. And if you can't answer that question, you can't buy the stock. You can gamble in the stock if you want to, or your neighbors can buy it. But if you don't answer that question, and I can't answer that for internet companies, for example. There are a lot of companies, there are all kinds of companies I can't answer it for, but I just stay away from those. Number two.
So you got formulas involved in finding intrinsic values on certain companies. I mean, you've got a mathematical system set up.
Discounted present value of future cash, yeah.
Second short question is, why haven't you written down your set of formulas or your strategies in written form so you can share it with everyone else?
Well, I think I actually have written about that. If you read the annual reports over the recent years, in fact, the most recent annual report, I use what I've just been talking about. I use the illustration of Aesop, because here Aesop was in 600 BC. Smart man, wasn't smart enough to know it was 600 BC, though. I mean, it would take a little foresight. But Aesop, in between tortoises and hares and all these other things, he found time to write about, birds. And he said, a bird in the hand is worth two in the bush. Now, that isn't quite complete, because the question is, how sure are you that there are two in the bush? And how long do you have to wait to get them out? Now, he probably knew that, but he just didn't have time because he had all these other proverbs to write and had to get on with it. So, but he was halfway there in 600 BC. That's all there is to investing is how many birds are in the bush, when are you going to get them out, and how sure are you? Now, if interest rates are 15%, roughly, you've got to get two birds out of the bush in 5 years to equal the bird in the hand. But if interest rates are 3% and you can get two birds out in 20 years, it still makes sense to give up the bird in the hand because it's all gets back to discounting against an interest rate. Problem is, often you don't know, not only how many birds are in the bush, but in the case of the internet companies, there weren't any birds in the bush. But they still take the bird that you give them if in the hand. But I actually have written about this sort of thing and stealing heavily from Aesop, who wrote it some 2,600 years ago. But I've been behind on my reading.
So that was the man himself. Let me rephrase exactly, or let me just summarize for you this particular statement. So if I have got two birds in the bush, and
okay, here we go. In this video, I'm going to take the time to explain exactly.
1 second, sorry about that. So let's say I basically would like to, let's say I have got two birds in the bush, and the interest rate is 3%. And he said roughly what I think he said something around 18 years odd. So from the rule of 72, and if you look at 72 divided by 3 is roughly 24 years odd is fine for me to double my money because I have one bird in my hand and I've got two in the bush. So if I have to equal it, even if I make double the money in the 24 or 18 years odd just to beat the fixed deposit is great. Now today the FD rates are absolute, let's say 4%. Let's say they will go to 5%, 5.5%, let's say 6% dollar return. So even if you double your money in 12 years in the stock market, that's absolutely fine. The basic challenge is first of all, we are not okay with that because we want to see our portfolio up all the time, which is not possible. The second thing is you're absolutely correct that I am not here to make 6%. I'm here to make, let's say, 12%. So if you are here to make 12%, then even if you get those two birds from the bush in 6 odd years, it's absolutely fine. Now, the question you need to ask yourself, have you invested for 6 years, knowing what you have invested in, and yet your money, or you have not got those two birds from the bush equal to the bird you have in the hand, then actually you are in the wrong place. But if you're stock investing or your stocks are momentally down by 20-25%, that's absolutely fine because that's all about the stock investing. And I don't want to interfere with the natural process because I showed you the track record of these investors, and let me again show it to you, and let's see the negative return which they have in a given year, because that's what all the investor needs to understand, that there are years, for example, if you look at 28% return negative for the parliamentary investor in 1973. So this kind of things are possible. Now look at this investor who is a super investor, 42% negative return in 1973. Now something would have definitely happened in 1973. This man has 15% negative return or 13% odd negative return. It is 31 and 31% negative return in 1973 and 74. And this is Charlie Munger. This is no foreign person. It is a Charlie Munger Sequoia fund, which is basically had 24% and 15% negative in 1974. So that's absolutely fine, my friends, if you have a year or two. But what you need to figure out that one thing is whether I will be completely vanished because I have leveraged money, or I have short-term investing horizon because I don't understand long-term investing. But these are all long. Stock itself is a long-term investing product. That is what I want to tell you. Now look at this man. This man has salute to him. TBK overall is not showing any time negative except this one 1970, though index has gone 38% down. So this is also possible. And obviously I might not be from that school of thought. Now coming to WGS partner, this man is also very smart, 9 and 8% negative only. So there are possibilities, but these are all come under the super investors. So there are 1 or 2 years, but what you need to focus is, if I want to achieve 12%, have I given 6 years and my money is not doubled, or I don't see it getting double, then you should be definitely worried. And the second thing is, will I lose all my money? Now, coming to the concluding statements. So this is the thing I talked about. We talked about that they all belong to value investing philosophy. We discussed value investing. Now we discuss intrinsic value, how to calculate the intrinsic value. And these people have found that discrepancy, and accordingly they have bought in the stock. Now, third point is, they were not about making much of the money. They were about not losing the money. And when I say that not losing the money, there are two concepts here. One is the margin of safety, which we'll discuss in the next point. The second is, they don't want to completely wipe out from the market. And Warren Buffett has mentioned about one person who was so famous at his time, and he would leverage, and he used to make good money. Even Ben Graham had taken leverage. I don't know how many of you know this. And I don't want to comment on your investing style, because some of you think you're smart enough. And you should be, and I would wish you all the best. But there are people who have taken leverage and they wiped out. And the investing community overall lose this kind of people. We call people, and we find that some of them are so close to investing in the stock market because they had such a devastating experience in the past because of the leverage. And in the last 7-10 days, whatever selling you are seeing, a silent selling is happening, because I am not selling. Your portfolio, you are not selling. Who is selling? People who are leveraged, they are just going out of the market, because market can be solvent the time you can stand by. So market can completely wipe you out. So that's one very important phenomena. And Charlie Munger said, I don't want to just tell me where I will die, and I will never go there. So leverage is a place, stock shorting is a place, derivative is a place where I feel that I will die. I don't want to go there ever. And even this gambling kind of the stocks like DocuSign, etc., at Peloton, at a very high price, I don't want to get there because I don't want to die. And that's what it is. Coming to the fourth point, the principle of margin of safety. So whenever you pay less than the intrinsic value of a stock, which we just learned how to calculate the intrinsic value. Intrinsic value is nothing but discounted future cash flow. That if I lay down $130 million today, how much I will gain back in the next 5 or 6 years. So that's all about the margin of safety. Now let's hear from Warren Buffett. What is margin of safety and how to apply that?
How do you estimate the future growth of the business? And how do you decide what margin of safety to use? Thank you.
The future growth and what, John?
Well, I have difficulty understanding that question fully. He's talking about how do we combine our estimates of future growth with our passion for having a margin of safety. Surely you can handle that.
Well, I can certainly handle as well as you can. Every time he laterals them off to me, he calls those audibles. You calculate, I think you take all of the variables and calculate them reasonably conservatively, but you don't try and put too much windage in at every level. And then when you get all through, you apply the margin of safety. So I would say, don't focus too much on taking it on each variable in terms of the discount rate and the growth rate. But try to be as realistic as you can on those numbers, but with any errors being on the conservative side. And then when you get all through, you apply the margin of safety. Ben Graham had a very simple formula he used for just the most obvious situations, which was to take working capital, net working capital, and try and buy it at a third off working capital, and overall that worked for him. But that method sort of ran out of steam when the sub working capital stock disappeared. But it's the same thing we do in insurance. I mean, if we're trying to figure out what we should charge for, we'll just say the chances of a 6.0 earthquake in California. Well, we know that in the last century, I think there have been 26 or so 6.0 or greater quakes in California. And let's forget about whether they occurred in remote areas. Let's just say we were writing a policy that paid off on a 6.0 or greater quake in California, regardless of whether it occurred in the desert and did no damage or anything. Well, we would look at the history and we'd say, well, there have been 26 in the last century. And we would probably assume a little higher number in the next century. That'd just be our nature, but we wouldn't assume 50. If we did, we wouldn't run any business. So we might assume a little higher. I would, if I was pricing it myself, I'd probably, I'll assume they're going to be 30 or maybe 32 or something like that. Then when I get all through, I'll want to put a premium on it that now puts in a margin of safety. In other words, if I figured the proper rate for 32 is $1 million, I would probably want to charge something more than $1 million to build in that margin of safety. But I don't want to hit it at, I want to be conservative at all the levels, and then I want to have that significant margin of safety at the end. And I guess that, as I understand the question, that'd be my answer. Charlie, you want to add to that?
Yeah, that book, Deep Simplicity, that I recommended to you, says that you can predict out of those 26 earthquakes how the size will be likely to be allocated. In other words, there's a standard power law that will tell you the likelihood of earthquakes of varying sizes. And of course, the big earthquakes are way less likely than the small ones. So you count the math and you know the applicable power law and you guess as to how much damage is gonna, it's not that difficult.
If somebody said they really want to protect against a 9.0 or something like that, then you know, is it one in 300 years? Is it 1 in 1,000 years? You know, well, you get really off the data points. But that is not what you're looking at in investments. You don't want to look at the things that are that. You don't want to come up with companies where you make the assumptions that they get that extreme. And you don't have to. That's the beauty about investments. You only have to look at the ones that you feel capable of evaluating, and you skip all the rest.
So the margin of safety is what is explained as basically I don't overpay for a proposal. So generally on $1 I pay 40 cents, and Ben Graham has paid roughly 1/3 of the net working capital, but those days are gone now because we now value investing is applied on because the companies who are great, they are always at a fair price. Like Apple has not fallen much, or let's say a good company which is not fallen 30, 40, 50%. Very difficult to wait for these kind of crises, because whatever happening is now is not going to happen again and again. So it's a once in a lifetime opportunity in 2022. And I don't know how many of us will be able to buy and take the plunge and benefit. So in my opinion, margin of safety is very simple, that when the company is buying their own share, it is a time to get in. And if those companies have a significant track record, then I think you will not go wrong. So I repeat, my way of margin of safety is go to the financials and check if the company has purchased their stocks, or you can go to the financial report and find exactly what price they bought in. 5 to 10% here and there if you pay, and if they have a great track record already in the past, you might buy at the price where the management is buying. We applied the same principle in Denos shipping, and we made 8 and 9 times in the 1.5 year. Today also we saw that a lot of companies are buying their own share, but eventually we are not having the cash to deploy. But if you have your own portfolio and you have these companies, and out of that, let's say you know the track record of some companies, go and check, and 90% these companies are already buying back their own shares. That's the time to get in, and that's nothing but you are actually paying less than the intrinsic value. Last point is their focus unwavered toward the long-term approach of value investing. What a great line. Long-term approach of value investing. If you do not have a 5-year horizon, please don't be in the stock investing. There's no point seeing the price and feeling very bad about it. You're not the one who's losing money. Everybody else is losing the money because politicians take the control. And even the Fed is a puppet in the hand of the politician. And there's a Russia war. And today morning, I got a news about China. All these things are immaterial. So either you be in the stock market for with a 5 to 7 year horizon, or else don't just watch your look at your portfolio price. A lot of people tell me, what is the score? What is the score? All these things like a cricket match. We're not gambling here. It is the reason why stock market is not known to everybody, because you don't make money every day here. But once you make money, you make tons of money. And today also I have stocks which are 7 times in my portfolio. I don't even look at them, because when you look at them, you crave to sell them. On that note, I think I call the session done. We have exactly completed one hour. I think I have a question to take from someone. I'll just take that question. And if you have any question, feel free to ask. And quickly we wrap up in 5 minutes. So I have a question. If we do not sell the stocks, how do we get the cash back? Through dividends? What if the company does not distribute dividend for a long time? A very good and very naive question from Harshna. So what Warren Buffett said, he himself said just now, that Berkshire Hathaway never ever delivered dividend. So dividend is not the answer, because if you are buying a dividend stock company, you will never match the return of the economic growth or the, let's say, 15-20% growth. Now, why not the dividend company? Because generally company pays a higher dividend when they cannot grow the what do you call the capital in the business at a higher rate. So that's why one should avoid the dividend company. Now, how do I get my money back? So let's say you invested $100, and if company can grow their free cash flow or profits or cash flow at a rate of 15%. So how much it will become? So if I invested $100, the company is delivering $15, 15 itself will become 100 more in the next 5 years. Now you actually made double the return. Now, if you want the cash, take out how much you want. That's how you will get your return. So let's say you said 5 years enough for me. I don't want to be in the stock business, or I don't want to be in this stock. You can withdraw the whole money. But the point here is, if you would have done that on Berkshire Hathaway stock, or let's say you're going to do in my strategy in the future, what eventually will happen? You have to find another venue to invest that money. Now, what are the chances that you will again do well? One, and how much headache you have to take? Second. So this should be done in the property business, because buying at distress is a very difficult in this part of the world, at least. So you buy at a lower price and sell and keep making money. But in the stock, if you want the cash, take out what you want and let it compound. So don't buy a company for a 3-year horizon, buy a company for a 30-year horizon. And whenever you need money, since the company has done, a company is already compounding the capital at 15%, you have 10 odd company in your portfolio, 20 odd companies. Your portfolio will always, after 3 or 5 years, will be above your investing value. Whatever you need, you take it out and you enjoy that. That's how you can get your profit. I hope I answered your question.
Thank you, sir.
Yeah.
Understood.
And anybody else? We can take 2 more questions and then we can wrap up the session. Okay, I think, thank you. Thank for time. Thank you for joining us from across the world. If you have any personal question, my WhatsApp is available. If you would like to invest us, please approach us. Brilliant time, whether you invest through us or not, but this is a brilliant time. Invest in the stock market. Don't look for the next 6 months or 1 year. They could be very volatile, but I think the journey from here in 3 to 5 years is very, very good. So compare that when you buy a gold. So I'll just give you an example before I end. My sister bought gold, let's say a month ago in Dubai. And she's very happy today because she's not watching the gold price, which has roughly gone down 10 to 15%. But where a stock investor who bought stocks 3 months or 6 months ago, he's watching his portfolio is very, very unhappy. And this unhappiness is not letting him buy more. Where my sister is very happy because she's never going to look at the price. And she's such a, the programming happened in such a manner that she will never even think of selling. And that's how, if you do it, stock investing, and what happened in Fidelity, where this man who died after investing made the highest return. The problem is when we look at the stock market, we are looking to make money every day and we feel so proud. Wow, my money has become 100% or 50% and 20%. And that's what gives us a very unhappiness when the market goes down. So why not what we do with gold and property? Why don't we do that with the stock? Is the question I leave you with. And I think on that note, I call it a night or a day. So good day in Canada and America, and good night in UAE. Thank you, friends. Have a great day.